everyone. So for today's video, I'm going to be doing a quick overview of how to use the present value formula and how to use the present value of an annuity formula. And for this first problem, I'm going to be also focusing on how to record the journalizing entries for this set. So for the first problem, it says, a firm purchases a new company car for its CEO on January 1st, 2020. They pay $20,000 cash and the rest as a note payable for $64,000 to be repaid at the end of 2 years. This $64,000 represents both principal and interest. Assume that the market interest rate is 5%. Provide the appropriate journal entries for the next 2 years beginning on January 1st, 2020. And assume that the firm has a fiscal year ending on December 31st. So to record the purchase on January 1st, we're going to debit car, which is an asset because we're getting a car, and we're going to be crediting cash because we're paying cash, and that's going to decrease, and we're going to also credit notes payable since we're paying kind of on account, and that's going to be a liability, and that's going to increase. So first we know that on January 1st, we're paying $20,000 cash. So let's put in $20,000 right there. And we can't say that note payable is going to be $64,000 because it says that we're going to be paying at the end of 2 years. So at the end of 2021, we will be paying $64,000. But for right now, we have to find the present value of the car. And oops, I need to move this down right here. Okay, basically to find the note payable or the present value of the car, we're going to be using the formula that's listed right here above. So first, I'm going to do 1 divided by 1 plus 0.05, which is the interest rate, to the power of the number of periods, which is 2. And then we're going to multiply that times 64,000, and that's going to give us $58,000. And so the present value of the car is going to be a total of probably about $70,000, I'm guessing. Yeah, $78,000. So that's how you record the purchase of the car. Now we have to do the adjusting entry. So at the end of 2020, we're going to record the interest expense, and it's going to be a debit, and we're going to credit note payable because we owe more money in interest. And the way we find this, the way we find the interest expense is we're going to multiply the present value of the car times 0.05, which is the interest, and that's going to be a total of $2,900. And you're going to put that same amount under note payable. You're going to credit that. And then now we're at the end of year 2. So we're going to do the same thing. Interest expense, debit, note payable, credit. And in this case, so at the end of year 1, for the adjusting entry, we're going to have a total of about 61,000. And that amount, we're going to multiply that by 5%. To find the interest expense for that year. So it's going to be 60,000 times 0.05. That's going to give us $3,047 dollars. And then we're going to just credit that same amount right there. And yeah, that's how we record the adjusting entries for the 2 years. And now that we're at the end of 2021, we are going to go ahead and pay for the whole, pay for the car. And basically what we're going to do is we're going to debit note payable, and we're going to credit cash. So we're going to go ahead and add 60,000 plus the 3,047. And that gives us exactly $64,000, and we're going to go ahead and credit that $64,000. So yeah, that's how we do or use the present value to calculate the interest rate for this part right here. So hope that makes sense. But now we're going to move on to the present value of an annuity, and we're going to be incorporating both the present value and the present value of annuity formulas. So for the second problem, it says you just won $10 million. The lottery offers one of the following three options: lump sum payments of $10 million at the end of 5 years, equal payments of $2 million over the next 5 years, equal payments of $1 million over the next 3 years, and then a lump sum of $7 million at the end of year 4. So assuming that the market rate is 10%, calculate the present value of each stream of payments as of today, and which option would you prefer? So for part A, it says we got a lump sum payment of $10 million at the end of 5 years. So we're going to go ahead and use the present value formula, and that's going to be 1 divided by 1 plus 0.1 to the power of 5. And we're going to multiply that times 10 million. And that's going to give us $6.2 million. For option B, it says we're going to be getting equal payments of $2 million over the next 5 years. So we're going to go ahead and use the present value of annuity, which is a little bit different. And what we're going to do is we're going to do 1 minus 1 plus 0.1 to the power of negative 5. And then we're going to multiply that. We're going to divide that by 0.1, or the interest rate, 10%. And then that's going to go ahead and, that's going to give us the interest rate, and we're going to multiply that by 2 million. And that gives us $7.5 million. And then for part C, we're going to go ahead and use both the present value and the present value of an annuity. So right here, let's just see. So I'm going to go ahead and use the present value, enter it right here. And actually, I'm going to go ahead and start off by using the annuity formula. So it says equal payments of $1 million over the next 3 years. So we're going to be doing 1 minus 1 plus 0.1 to the power of negative 3. And then we're going to go ahead and divide that by 0.1. And make sure you use the right amount of parentheses. I know that can be a little bit confusing when using Excel. But yeah, definitely be aware of your parentheses in the placement, because that can definitely change the number. Because without this parenthesis, without these two parentheses here, I would be multiplying 0.1 times the 1 million, and that we would just be, doing this divided by 1 million, and that wouldn't be correct. So definitely make sure you use, you place the parentheses at the right place, and then you're going to just go ahead and multiply that times 1 million. Oh, wait, hold on. Oops. Okay, 1 million, and that's going to give us 2.4 million. And then we're going to go ahead and use the present value, and that's going to be 1 divided by 1, hold on, let me just make sure. 1 divided by 1 plus the interest to the power of number of periods. Okay, so it's 1 plus 1 plus 0.1 to the power of 4, and we're going to multiply that times 7 million. And that gives us $4.7 million. Now we're going to figure out and see how much that would give us in total. So I'm going to use the sum function, add those two together, and that gives us a total of $7.2 million. So of the three options, it looks like we're going to go ahead and stick with option B because it gives us the most amount of money back from the 10 million.